Hello, my name is Woohyun, and today we'll be discussing about price stabilization, which is fiscal and monetary policy. This is one of the most important concepts in AP Macroeconomics, so you should be fully comprehended of it. Also, we express great gratitude to Letitu for sharing the resources. So the lecture will be proceeded in the following order. And let's review what was the business cycle and the priority. Every economy reflects expansion and depression in a certain period, like this graph. In this, it can naturally restore equilibrium with the policies and government interventions in the long run. However, we cannot define when we could reach the long run, and the famous economist Keynes has said, "We will die until waiting for the long run." So, economists felt necessity to make a government intervention to directly solve the economic problems. So there are many two types of policies. The first one is fiscal policy that is implemented by government, and the second one is monetary policy that is done by the central bank. For example, Bank of Korea, Federal Reserve, Bank of Japan, and any other banks that are functioning as the central bank for a nation. And these two policies pursue a same goal, that is first, price stabilization, and second, full employment in the short run. This can be done by increasing or reducing aggregate demand curve to equilibrium. And in the long run, it pursues economic growth, and like this is usually we have to deal with AS curve itself. Anyway, today's policies will discuss about the principles and mechanisms that fiscal policies and monetary policy have to deal with economic depression or abnormal expansion. To begin with, we have to know what is government budget constraint. It is the amount of money that government can spend. This is T, tax, plus B, bond, plus M, money. And money equals to government spending. And if the G minus T equals 0, it means it has reached the budget balance. And in other words, if the G minus T is greater than 0, it means it is experiencing budget deficit. And if G minus T is smaller than 0, then it is experiencing budget surplus. And like I said earlier, Keynesian highlights government intervention to create valid demand because they believe demand creates supply. So, fiscal policy, according to its definition, it is government discretionarily regulating its spending or income tax. Discretionarily means flexibility. Or like it is decided by government. So it is usually done by regulate decreasing or increasing its spending or decreasing or increasing the amount of income tax. And like this is two types, expansionary fiscal policy and contractionary fiscal policy. So in case of expansionary fiscal policy, it is done in recession to combat with it, and to create more demands, government will make more spendings and it will reduce tax for the citizen. Like let's think of when you're experiencing serious COVID-19 issues. Government provided like cash vouchers and or direct cash aids to citizens. So this is kind of expansionary fiscal policy to combat with the depression. And as seen in the graph, as a result of the policy, the AD curve has shifted to the right, and therefore it retrieved the equilibrium. Therefore, it could close the recessionary gap. However, let's look at the second case. It is the contractionary fiscal policy is implemented during expansion to deal with abnormal inflations. So government will decrease its spending because more money in market means it causes inflation. And also it will increase the tax for the citizen. And as a result, the equilibrium has moved from A to B, which is corresponding with normal AS curve, and therefore it could close the inflationary gap. So these are the main principles how fiscal policies have to deal with economic crisis. And let's look at it as effects. As we read earlier, aggregate demand is composed of consumption, investment, government spending, and in that export. And if the government spending increases, then G increases and therefore AD also increases. Also, if the tax changes, then it indirectly affects consumption and investments because if there is more tax burden, then households and firms will reduce spending and investments. So this was how fiscal policy can affect the AD curve. And to be more specific, it is more helpful to remember the concept of spending multiplier. Spending multiplier means how was the result greater than its original GDP? Because as you know, the total output should be better than original one if the policy has to be successful, right? So multiplier is kind of criteria or measurement to evaluate that. And it can be calculated by 1 divided by 1 minus marginal propensity to consume. And marginal propensity to consume means the change of amount of consume when certain money is given. Then save, because it is actually contrary to consuming. It is change of how people save when certain money is provided. So it can be calculated by these two ways, and usually MPC and MPS will be given at the AP exam, so you have to be ready to calculate for the multiplier. And it is always bigger than 1 because the change in GDP is greater than change in expenditure. Great, so let's move to the next step. So automatic stabilizer is kind of non-discretionary way, it means fixed way of fiscal policy. So there are two types: progressive tax and unemployment benefits. progressive tax is that income tax increases a lot corresponding to amount of income that one earns. So that it is called progressive. And unemployment benefits is cash aid provided to unemployed. And these two types of policies can reduce fluctuation of income after taxation. And therefore, it also supplements fiscal policies in non-discretionary way. However, there exist limits of fiscal policies, especially their time lags and political constraints, because it needs agreement of public and parliament to pass the fiscal policy of government, because it cannot be solely dictated by the president. And also, this is very important concept. Crowding out effect is government spending obstructs consumption and investment because it actually raises interest rate. And you can think like this, like amount of money is fixed in a market, and like if the government takes about this, then C and I necessarily decreases. So crowding out effect is pointed out as one of the most critical disadvantages of fiscal policy that reduces the efficiency. Then let's move to monetary policy. Then we have to know the main functions of money first. I think it is better to memorize it. The first one is unit of account. Second one is medium for exchange. And third one is retention of its value. And monetary supply is central banks such as Fed, BOK, BOJ adjusting money supply or interest rate, again to cause recession or expansion. So there is difference in who does policy. While the fiscal policy was done by government, it is done by central bank. Also, it adjusts money supply itself or do it by adjusting the interest rate. We also should know that if money supply increases, then interest rate decreases. Easily thinking, we can consider interest rate as a value of money. If money supply increases, then the value of money will be depreciated, therefore interest rate will also decrease. And these are roles and functions of Federal Reserve in America. And like there are kind of one or two questions asking about this. So I thought it'd be better to cover some points. It runs independently regardless of the government. Therefore, it is irrelevant with U.S. government itself. And also, however, chairman is appointed by president, and he lasts for 4 years. Also, it forms Federal Market Committee (FOMC) to pursue monetary policies, and we will take a deeper approach later. Also, it consists of 20 district banks across the U.S. 12 district banks. And it also issues currency and provides rent. This is actually very normal and granted function of banks. Also, it is intermediary for the government. And let's look at the money creation. Why does increasing money supply contributes to decrease the recessionary gap? It's because um it's because of money creation process. For example, this is the central bank, and like this is bank one, bank two, bank three. Let's consider that central bank has 100. Then central banks lends. Then let's imagine the central bank leaves 5 for its own and lends 95 to others. Then bank one will also raise the 5% and give others to bank two, and bank two will also leave 5% and like it also give others to bank three. So like money is conveyed to other banks from the central bank, and in this process the amount of money is actually increased geometrically from the original input. So money creation is the process of expanding the money supply from the central bank to bank 1, 2, 3, 4, 5 to local banks. And this amount that the banks leave for its own is called reserve requirement. Required amendment a fraction of deposits in the vault at other times. Why does the bank need reserve requirements? It is because when the sudden economic crisis happens, then like many people will come to the bank to obtain their money. However, if the bank lends all the money to other banks, then it cannot provide money to as consumers. Therefore, to prevent bankruptcy, in emergency case, most of the banks always leave their reserve requirement in its book. And we also have to know what is money multiplier. It is same as spending multiplier over there. So it also shows how was the force was effective by calculating how lots of money was created than as original input. And it can be easily calculated by 1 divided by reserve requirement. So we have to remember this formula actually. And monetary policy also has two types, expansionary and contractionary. As function is same with when it was at the fiscal policy. However, the central bank takes other actions. And in expansionary, it increases money supply and it reduces interest rate. Like for example, it was also same at the COVID-19. The United States government has implemented quantitative easing to raise up the economy, and like when the China had a crisis in front of bankruptcy due to Honda crisis, it also reduced the interest rate to raise up its economy. So like these are examples, and like however, in the contradictionary monetary policy, it decreases money supply, and it increases interest rate to prevent too much inflation. And this page is really important. These are tools of monetary policy. How does the central bank can regulate its money supply or interest rate? So the first one is open market operation. So open market operation is opening market to government or other institutions to sell or buy their bonds. And central banks will buy the bonds for the expansionary policy and sell the bonds for the contractionary policy. And like it can regulate the amount of money that is flowing in the market. So this was the first method. And second method is adjusting the rediscount rate. Rediscount rate is interest rate that is applied to financial institutions or other banks. In this case, the interest rate of this amount of money that is lended from central banks is rediscount rate. So, increasing the rediscount rate can be done in expansionary policy because it can increase the money supply. However, decreasing the rediscount rate can be done in contradictionary policy. Also, third, it can also adjust required reserve ratio. So, in the expansionary policy, the reserve ratio will decrease because it have to promote more money creation. However, in contractionary policy, it will have to increase the required reserve ratio. This chart is also really important. You must memorize it. And fourth one is, like mentioned earlier, this is kind of quite new method that was introduced in Obama regime at the Lehman Brothers crisis. Quantitative easing is increasing money supply through unconditional and infinite bond purchase of central banks. So like central banks buy the bonds as much as possible to raise up an economy. However, it also has serious side effects of inflation, like we are experiencing now. And there are limits of monetary policy that is timeless. This is also similar to fiscal policy and ineffectiveness in recession. This is mainly divided with two. So the first one is liquidity trap. It means even though we reduce interest rates, the economy does not raise them. Even the interest rate is below zero. The second one is because the people's rational expectation. So every people have ability to expect what will happen to our economy soon. And it actually harasses the efficiency of policies because people will act according to their expectations in advance. So these two factors cause ineffectiveness of monetary policy. And last one is about monetary perspectives. So classical monetarists and Keynesians suggest different views on the effectiveness of monetary policies, and classical suggest that a direct correlation between price level and supply. And monetary monetarist asserts that Fed should focus on controlling money supply itself, not the interest rate. This emerged in 1970s. Last, the Keynesian economist has claimed that changing in money will affect the interest rate. So it agrees with the relationship between money and interest rates. So this was the end of prepared lecture today. And thank you so much for listening. Also, please don't forget to press like and subscribe button if this lecture was helpful. Thank you and see you at the next lecture. Goodbye.